And now we get to turn to our favorite topic on China and what is happening in China. What are some things that are going on? So we want to look at, what are some of the recent data points, and we got some, and they're pretty much in line with what you would think they were going to be. But let's go through them in pieces. So you have the current account balance came in at 88.9 billion. Pretty close to the prior, just a billion down. Again, not a huge shift. Industrial profits year to date. In April, they were 3.5%. Now they're 1%. Again, moving in the wrong direction. Industrial profits year over year, negative 8.5%. Last month in May, negative 6.5%. So still negative, still contraction. Composite PMI, this is where it gets a bit more positive. So here you had last month, it was 48.4 in May. This month, 54.1. Manufacturing, the expectation was for 50.5. They came in at 50.2. So again, just about eked out some growth on the manufacturing side. Non-manufacturing was where we had that nice bounce, was expected at 50.5, came in at 54.7. So before we go into and look at some of those specific numbers, you have to consider that people were locked down. So non-manufacturing services, things that people couldn't do, they're going to rush out and do. But when you look at the manufacturing, which is going to encompass both exports and local consumption, it just barely grew. And that's where, when you look at what has been the biggest driving force of the Chinese economy through the COVID downturn, it's been exports. And the manufacturing side is showing a lot of that weakness and a lot of that pressure that we think is going to continue on. So now when we look at China manufacturing PMI, again, just eking out some of that key piece. And then non-manufacturing, still off of that 2021 high, but again, back to a bit more normalcy. So we do expect, so just to give you an idea of what our expectations are, we expect China manufacturing PMI to stay just above 50, and we expect non-manufacturing PMI to fall back to at 52 based on some of the key leading indicators that we're going to discuss in a moment. Now, input prices for manufacturing PMI came in at 52. They have normalized a bit, still not contracting, so still expanding, but at a much slower pace. And that's because the government has done a ton to try to get in front of a lot of these prices, which is, again, keeping things lower. But you have to think about the cost. How much is this costing the government, and do they have the spare capacity to afford it? And that's where we think that is going to be short-lived. China manufacturing PMI, the backlog of orders, again, 44.2. So this is what we're talking about on those leading indicators. You're talking about something that is significantly below 50, and that's where those leading problems continue to emerge, which is showing the export side, the local side. So the backlog of orders continues to be an underwhelming piece, especially, I should say, married with the fact that new export orders and orders are slowing. So the monthly stress gauge suggests that weaker corporate demand. So we are seeing, again, less and less demand from, and this is speaking from the point of debt and what the corporate demand looks like. And they keep talking about supply. We have to make more debt available. We have to do more stimulus. The consumer nor the corporation want it. It's not a shortage of supply, it's a lack of demand. And I think that's where they keep getting some of these two pieces confused. And a lot of it is the uncertainty around the zero COVID policy, because nobody knows or can corporately plan, well, am I going to have a lockdown? Am I going to be able to get my employees? Am I going to be able to get my inputs, whether that be, some sort of manufacturing or semi-finished good or raw material? So that's why when we're starting to see some pushback from the central government, but not enough. So the central government is clearly worried about the negative impacts of overly excessive COVID restrictions. On Friday, the State Council's interagency COVID response team held a press conference to name and shame a number of local governments. So when you look at the two broad, simplified, and one-size-fits-all corporate COVID measures, Baoding, Handan, Xinjiang, Hebei province. So again, you're seeing some of the key pieces, but Beijing wants to make such public criticism a routine practice. This latest round of naming and shaming follows the state council's singling out of 4 naughty cities on June 11th. So they've gone further at this point. As of Friday, Hangzhou has dialed back testing from every 3 to every 7 days. On Sunday, Suzhou abolished the requirement to show proof of negative test results when entering public venues. It's a good sign that the central government understands the free flow of goods and people, but without a serious shift in zero COVID policy, any economic recovery will remain weak, which is, again, what we expect, because they're shaming, they're trying to normalize some things, but they're not getting rid of it. And they still put high priority on capping any spread of COVID. So as long as that remains priority number one, that's what the government, the local governments will default to, impeding some of this growth. So China industrial profits following right along 2021, more than 2021, but less than 2020 when you look at monetary and fiscal stimulus by year. So when you look at what is being done, you have local and central special purpose bonds, again, nothing major. But when you look at general budget spend has increased, and the PBoC tools and profit transfer have also increased. So that has been the biggest shift. We're getting tax and fee cuts. That's bigger. So the liquidity and via our RRR and general budget spend, the liquidity and RRR have gotten cut. Tax and fees are going up. So, but when you look at it, they did it in 2020. They did it again in 21. They're doing it again in 2022. So this expansion, this is how they make money. This is how governments function. They take in revenue, but they continue to cut rates. They continue to cut fees and taxes and all these other key ways that these governments are supposed to fund themselves, which is going to limit the amount of stimulus they can push back in. So now when we summarize some of the key pieces of the stimulus plan, so tax rebates and fee cuts, refunds, waivers, and reductions to corporate income tax, VAT, and individual income tax, committed to $225 billion. Special purpose bonds, again, front-loaded issuance, as we've been talking about. Monetary policies, PBoC profit transfer, transferring $150 billion in USD profits to governments to be primarily used for tax refunds and transfers to local governments. So trying to, again, backstop. RRR cut, first cut in 2022, was significantly smaller than previous cuts. So again, that's where we see more of it, but not as much. LPR cuts, lowering rates will reduce cost of borrowing for businesses and mortgage borrowers. Relending have been limited so far, but when you start looking at the scope, now we turn to what has just been said about what the government is going to do in the central bank. So the PBoC, that was they're helping, but there's limits to what they can do, which based on the leverage issues and everything else we've talked about. The message on monetary policy from the governor Yang in a recent interview. While most of the interview transcript was posted to the PBoC on Monday was about green finance, Yi also had few words on the economy. Specifically, monetary policy will continue to be accommodative to support economic recovery. Maintaining price stability and maximizing employment are our high priorities. He also signaled that interest rates don't have much further to fall. That's the pivot here. He noted that time deposit rates are 1% to 2% and lending rates are 4% to 5%, that consumer price inflation was 2.1% in May, and producer price rose 6.4% last month. After taking into account the inflation level, you can see the real interest rates level is still pretty low. But he also suggested that in the long term, rates may have to decline further, noting that the trend for the past decade has been down. The natural interest rate level is mainly determined by the marginal productivity of capital and long-term demographic trends. But what do we have? We have weak productivity and an aging population. So weak productivity growth and an aging population are pushing down the long-term trend growth rate of China's economy, and lower interest rates are needed to accommodate this reality. Once COVID is over, the PBoC has demographic, climate change, and debt management crisis to deal with. And that's why we continue to see some of these hesitancies and why we don't see a huge surge in stimulus. Regardless of what is said, Beijing wants firms' financing costs to fall, and there's an expectation of more rate cuts, but it will be measured, if you will. And the reason why is, on Monday, Lee dropped in on the Ministry of Human Resources. Although the economy has recovered to some extent, the foundation is not yet solid, and the task of stabilizing employment is still arduous. The unemployment rate dropped slightly to 5.9% from 6.1%. But remember, as we said, that's last week, there's concern on new jobs. There's the 16 to 24 year bracket still has an unemployment rate of over 18%. So Lee also reiterated that the key to stabilizing employment is keeping businesses afloat. We should continue to implement all economic support measures and use development to facilitate employment. Lee's right, employment will only pick up with a turnaround in the economy, but current policy prescriptions appear insufficient to make that happen because there's these back and forth in terms of what can be done given the fact that leverage ratios are so out of control and there's no demand from the consumer or corporate level for this level of support. The sectors that have absorbed the most graduates over the past decade, namely IT, property, and education, remain in the doldrums. They won't return to full strength anytime soon, and that's where we continue to see this longer-term downtrend than what the market is expecting. Developers are under growing pressure even as developing funds are made available because there's an asset quality problem. There is what is your collateral? There is a huge backdrop of issues that is hindering their availability and their ability to get new funding, especially because they relied so heavily on the consumer for it. And and the international markets, which have essentially closed to them. And so have less money to spend at land auctions. So 50 city land sales value year over year is down over almost 80%, and the 3-month average is down 40%. And remember, this is how a lot of a lot of provinces and cities got their money. So without these dollars coming in, or I should say renminbi at this point, without getting this renminbi into their coffers, they have to rely more on revenue coming from taxes. But because they've cut taxes and fees, they now have to rely more on the PBoC. And the PBoC is saying that their hands are tied to a certain point. They're still trying to be as accommodative as possible, but you're seeing these knock-on effects. All of this is leading to the Chinese Sales Managers Index bouncing, still contraction, but manufacturing and service sectors continue to contract in June when you look at the world economic data, manufacturing and services. So there is some of that backdrop in terms of what is being looked at and how you factor in the different components, going back to the official PMI showing growth, unofficial PMI being calculated by someone else showing declines. There's some, neither is right or wrong. There's some truth in the middle. And that's why we think there's just kind of this bouncing along where, services we think is still, we think is still has some growth while manufacturing is in contraction still. Rising inventory levels by tier of cities. So the inventory levels defined as unsold inventory divided by average GFA sold in the past 3 months. So you're getting an idea on just the pressure that remains in these levels on inventory, on all components of the GDP calculation, which is going to make their numbers harder to hit. Which is why when you look at GDP growth falling way below the official target, so the nowcast model is actually showing 0% growth. So if you look at, even if you get some good numbers, they need to be great numbers and continuous in order to get even a semblance near where they had targeted their underlying growth trajectory. Now, when we start turning to Japan, the composite output PMI had a bounce, and you could see it is back to some growth, but the manufacturing output is starting to come back down and showing some contraction. And when you look at the recent data that came out, it actually contracted. So just to give you the exact numbers, and I apologize for not having them in the system, but when you look at where we are, so industrial production for May was expected to be at negative 0.3%, came in at negative 7.2%. So that's, again, more pressure to the downside. Retail sales were expected at 4%, came in at 3.6%. So again, all of these moves are heading in the wrong direction when you look at this expansion, as CPI is still sitting at 2.5%. So then when you start looking at services, that had a nice bounce, but margins continue to squeeze. That input prices are being driven higher and prices charged have not caught up. So as prices charged go up, that's going to increase the inflationary pressure, but also increase the export cost, which is going to hit the US and be another driver of inflation into the US markets. So then when you look at CPI for on the Japanese side, you can see it's sitting at 0.8. When you look at year over year at 2.5. But now look at the Japanese services PPI, the producer price index. The survey was for 1.7%. Actual came in at 1.8%. We're seeing that trend up. And based on, as we showed before, the huge backdrop and shortage between input prices and prices charged, this PPI, the lack of margin is going to push those prices charged up and is going to be an impact to both internal and external demand. Retail sales, as we said, was expected at 1%, came in at 0.6, moving in the wrong direction. As inflation continues to increase, we expect that to go negative. And if you adjust it for inflation, it is negative. Now, shifting over to South Korea consumer confidence had a hard dip to 96.4. And we expect that pressure to continue to move down, especially when you start factoring in all the different issues. So Japan consumer confidence expected at 34.8, came in at 32.1. Japan industrial production came in at 88.3. So again, South Korea and Japan, key export markets in the Asian theater, key trade partners for the U.S. are showing that slowdown, are showing those shifts, but prices still remain elevated. So again, it's that conundrum between where is inventory, where's global trade, but prices still remain fairly sticky. So here, then when you start looking at manufacturing PMI new orders in Japan, were negative 49.4. Again, leading indicators showing the pressure. Now, Japanese department store sales, you can see flatlined, still above where we were in 2020 and 2021, but still well off of normal. So you have local spending still sluggish, new orders coming down, new export orders negative, prices going up, just a very problematic backdrop when you're looking at growth. And now shifting over to South Korea, something similar. The PPI went back up. So again, sitting at 9.7%. With South Korea Business Survey for manufacturing coming in at 83, showing that negative trajectory. So here, costs going up, business surveys coming down, exports slowing, PPI going up, unemployment going up. Again, seeing these pressure points as trade slows, but even as trade is slowing, you still have a lot of that stickiness in terms of prices charged, prices received, which is going to be an import pressure into the U.S. as we continue to import some of that inflation. So that's what we have for you today. If you have any questions, again, you can find us in the comment section. You can find me on Twitter. I'm always happy to go back and forth. If you have any comments, suggestions, like one of these key driving pieces was a suggestion from the comments. Hopefully I answered your question. Probably went a little long-winded on some of them, so I apologize. But again, we thank you for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Prime Vision Network.